Let me start with a number that sounds fake, until you realize it's on the official scoreboard. $38 trillion. That's the U.S. national debt right now, not a forecast, not a by 2030, right now. And the weird part is, we've heard numbers like that for so long, they've stopped feeling real. But here's what makes this moment different. Something is shifting quietly in the background, without panic, without sirens, without a single headline big enough to match the scale of what's happening. The world's biggest institutions are gradually repositioning. Not with press conferences, not with dramatic announcements. Just steady movement, subtle decisions, quiet hedges. And if you know what to look for, those decisions are like footprints in wet concrete. Because this isn't new. This exact sequence, rise, overreach, quiet exit, then a break, has happened before. Not once, not twice, over and over across 500 years of history. So in this video, we're doing two things. We're going to map the cycle, step by step, using real historical examples. And then we're going to compare that pattern to the modern US dollar system and talk about what Stage 3 looks like in real life. By the end, you'll have a clearer answer to one big question. Are we watching another repeat, or are we watching something that breaks the pattern? Part 1. Why debt isn't the event. First, we need to fix a common misunderstanding. When people talk about debt, they talk like the debt itself is the crisis. But debt isn't the event. Debt is the setup. The event is what happens when confidence shifts. Because a reserve currency isn't powered by paper. It's powered by trust. Trust that your money will hold value. Trust that your markets will stay liquid. Trust that your government can service its obligations. And trust that, if the world needs to park money somewhere safe, your system is still the best option. Here's the simplest way to understand it. A reserve currency works like gravity. Global trade, finance, and savings naturally pull toward it, until something else becomes heavier, or until the center can't hold. Now, zoom out. The modern world runs on debt. Governments borrow, companies borrow, households borrow. Entire economies are built on credit expanding a little faster than cash. That can work for a long time, sometimes for decades, especially when growth is strong and interest rates are low. But the game changes when interest costs start climbing faster than incomes, faster than tax revenue, faster than productivity. Because then the system stops being a ladder and turns into a treadmill. You can run harder. You can't get ahead. Quick visual idea, on screen. Show, debt equals setup. Then, confidence shift equals event. Then, reserve currency equals trust. Part 2, the 4-stage reserve currency cycle. Now let's put structure on this. When historians and macro investors study major currency shifts, they keep seeing the same 4-stage arc. The details change, the names change, but the rhythm is strangely consistent. Here are the 4 stages. Stage 1. The rise. A nation becomes the center of trade and finance. It innovates, it industrializes, it creates deep markets. Capital wants in. Foreigners invest. The currency strengthens. This stage often lasts 50 to 80 years, sometimes longer. Stage 2. The stretch. Success turns into overreach. The empire expands commitments, military, political, economic. Debt grows faster than the economy. But because the system still looks strong, markets keep going, and the public stays calm. This stage can last 20 to 40 years. Stage 3. The quiet exit. This is where history gets sneaky, because Stage 3 rarely looks like collapse, looks like a slow rotation. Big money starts diversifying. Trade starts finding alternatives. Competitors rise. The public doesn't notice because day-to-day life still feels mostly normal. This stage often runs 18 to 36 months, but it can stretch longer. Stage 4. The break. Then comes the moment everyone remembers. A crisis hits, a war, a banking shock, a debt panic, a political rupture. Demand for the currency weakens fast. Inflation spikes, or deflation hits through a crash, or both in waves. Asset prices fall together because liquidity disappears, and the reserve crown shifts. Not instantly, but decisively. Mini summary. So the question isn't, is the U.S. in trouble? The sharper question is, which stage are we in? Part 3. Spain. Gold didn't save the empire. Let's start with Spain in the 1500s. If there was ever an empire that looked untouchable, it was Spain. It had military dominance, it had global reach, and it had something every empire dreams of: rivers of precious metal. After the conquest of the Americas, Spanish ships carried huge quantities of silver and gold back to Europe. On paper, it looked like unlimited money. But here's the trap. When money feels unlimited, spending becomes unlimited too. Spain funded wars across Europe. It expanded its bureaucracy. It fought to hold far-flung territories. And it borrowed heavily, because lenders believed the treasure would keep flowing forever. But flooding an economy with precious metal can cause a different kind of damage. Prices rose. Domestic production struggled to compete. And Spain became addicted to imports paid for by silver. Then the cycle turned. Shipments were disrupted by war, piracy, and logistical delays. Creditors demanded harder terms. Confidence in Spain's finances weakened. And here's the stage 3 moment. Money began to drift toward other financial centers, like Genoa and later Amsterdam, where banking systems and trade networks were becoming more efficient. Spain defaulted multiple times across the 1500s and 1600s. And the empire that felt eternal slowly stopped being the center of gravity. Takeaway from Spain. A resource windfall can hide structural weakness. Borrowing against future certainty becomes dangerous when the future stops cooperating. The shift begins quietly. Money migrates before headlines do. Part 4. The Dutch. Financial genius, then financial limits. Next, the Dutch Republic. The Netherlands in the 1600s was small, but it built something massive. The most advanced financial system on Earth. Amsterdam became a global trading hub. The Dutch created sophisticated markets for shipping, insurance, and finance. They pioneered early versions of modern investing and corporate structures. In other words, they built the plumbing of global capitalism. That's stage 1, the rise. But even the best plumbing can burst if pressure keeps building. The Dutch faced costly wars, geopolitical competition, and increasing debt burdens. And they faced something else. A rising competitor with a larger population, deeper resources, and a navy hungry for dominance: Britain. Here's how stage 3 looked for the Dutch. Capital didn't scream, collapse. Capital simply followed opportunity. Investors and merchants increasingly looked to London. Trade routes shifted. And the Dutch, despite their genius, lost the reserve crown over time. It wasn't one single day. It was a gradual transfer of the world's financial center from Amsterdam to London. Takeaway from the Dutch. Being first doesn't guarantee being last. Competitors don't need to destroy you. Sometimes they just outscale you. When capital finds a better center of gravity, the shift can be smooth, until it isn't. Part 5. Britain. The pound's long goodbye. 1300 to 1630, now Britain. For a long time, Britain was the center of global trade. The British Empire controlled shipping lanes, colonies, and commerce. London became the heartbeat of global finance, and the pound sterling was the currency of serious business. But Britain's decline shows something important. Reserve currency dominance can fade slowly and still end painfully. 2 world wars changed the math. Wars are expensive. They demand borrowing. They disrupt production. And they leave governments with obligations that don't disappear when the fighting stops. Britain's debt surged. Its gold reserves weakened relative to commitments. And the United States emerged from World War II with something Britain no longer had at the same scale: industrial dominance plus financial capacity. That's stage 3 in action. Global capital increasingly trusted the U.S. system. Trade and finance tilted toward the dollar, and eventually, the pound's role shrank. Britain even went through moments of currency pressure so severe that it needed external assistance. The reserve crown shifted, incrementally, until it wasn't really a debate anymore. Takeaway from Britain: wars accelerate the cycle. Reserve status depends on relative strength, not absolute pride. The world doesn't vote with opinions, it votes with capital flows. Part 6. How the dollar became the center. So how did the dollar become the center? After World War II, the U.S. had the biggest economy, the deepest markets, and huge industrial output. The Bretton Woods system anchored global finance, with the dollar connected to gold and other currencies connected to the dollar. But in 1971, the gold link was cut. From that moment on, the dollar became a trust-based system backed by the U.S. economy, U.S. markets, and U.S. geopolitical power. And trust can be incredibly strong. It can keep a system running for generations. But trust also creates temptation. Because if the world will always buy your debt, you can borrow more. And if you can borrow more, you can spend more. And if you can spend more, you can delay hard choices. That's how stage 2 begins. Quietly, comfortably, almost logically. Part 7. The modern setup. Why interest matters more than the total. Here's the critical point. A massive debt number is scary. But debt alone doesn't end empires. The interest bill does. Because interest is the part you have to pay every year just to stand still. When interest rates rise, governments face a brutal trade-off. Raise taxes, which can slow growth and cause political backlash. Cut spending, which can be painful and unpopular. Or borrow even more to cover interest, which compounds the problem. And there's a fourth option that's always in the background. Create more money, directly or indirectly. That can reduce the real value of debt through inflation, but it can also weaken confidence in the currency. So the system becomes a balancing act, especially when the world is watching. On-screen visual, triangle graphic, taxes up, spending down, borrowing up, center text. Interest costs force choices. Part 8. What stage 3 looks like today. Now we arrive at the most sensitive part of this conversation. Because stage 3 is not a headline, it's a pattern. And the pattern is made of small signals, not one country, not one event, a trend. Here are stage 3 signals you can actually understand without a finance degree. Signal 1. Diversification, not abandonment. In stage 3, big players don't usually dump everything. They diversify. They reduce concentration risk. They look for alternatives. Other currencies, commodities, real assets, different regions. It's not dramatic. It's prudent. And prudence is how transitions begin. Signal 2. More trade finds other rails. If more trade settles outside the dollar, the world needs fewer dollars to operate. That doesn't kill the dollar overnight, but it slowly reduces automatic demand. Signal 3. A competitor ecosystem grows. A new reserve system doesn't appear overnight. First, you get pieces. New payment systems, new trade agreements, more bilateral deals, and a stronger role for non-dollar reserves. Stage 3 is when those pieces stop being experiments and start being habits. Part 9. The Trap. What happens if demand weakens? Here's the trap in one sentence. If demand for your debt weakens, you either raise rates or print more. Raising rates can stabilize the currency, but it makes debt service harder and can trigger recession. Printing more can fund obligations, but it risks inflation and confidence loss. So stage 3 is about pressure building. Stage 4 is about which side snaps first. Part 10. What stage 4 could look like. Now, to be clear, stage 4 isn't guaranteed. History is a guide, not a script. But if the pattern completes, stage 4 often arrives with a catalyst. It can be a financial crisis, a major geopolitical shock, a banking event, a sudden spike in inflation, or a crash that forces emergency policy. Stage 4 tends to feel like multiple problems at the same time. Currency pressure, higher borrowing costs, asset price declines, and political stress because the solutions are unpopular. And here's why it hits regular people hard. When systems break, they don't break evenly. People with access to assets, leverage, and global options can reposition. People living paycheck to paycheck experience the shock directly through prices, rent, and job security. That's why understanding the cycle matters. It's not doomsday. It's awareness. Part 11. Practical moves. So what can a normal person do with this information? Not panic, not bet everything, not sell your life and move to a bunker. Just make smarter decisions with the reality we live in. 1. Don't be all in on one outcome. The biggest mistake is thinking the future is one straight line. Diversify, not just investments, but assumptions. 2. Reduce high-interest debt. When the environment changes, high-interest debt becomes a trap. The less of it you carry, the more flexible you are. 3. Keep liquidity and optionality. Liquidity isn't exciting, but it buys time. Optionality is power in uncertain environments. 4. Own what can't be printed, within reason. Hard assets have historically mattered during currency stress. That doesn't mean one asset, it means balance. 5. Invest in skills. In every historical shift, the most resilient asset was human capital. Skills travel. Skills adapt. Skills create income even when paper values swing. 6. Think globally, even a little. You don't need to become an international investor overnight. But understanding global risk, currency, politics, supply chains, helps you make smarter choices at home. Part 12. The big question. Repeat or reinvention. Now here's the most important perspective. The U.S. is not Spain. It's not the Dutch Republic, and it's not Britain in 1945. Modern America still has huge strengths: deep capital markets, innovation, and global influence. So the future isn't one outcome. The real issue is whether the system adapts before the pressure forces adaptation. Because every empire that avoided a hard reset did one thing differently. It made painful changes early, while it still had the power to choose. That's the difference between a controlled transition and a chaotic break. Let's end on a clear, honest takeaway. History doesn't repeat exactly, but it rhymes. Spain had treasure. The Dutch had the best finance machine on earth. Britain had an empire that covered the planet. None of that stopped the math. So if the signals we're seeing today look like stage 3, the quiet rotation, then the smart move isn't fear. The smart move is awareness. Because awareness gives you time. And time is the one advantage most people don't realize they still have. If you want the follow-up, the next video breaks down what historically performs best during late-stage currency transitions. What protects purchasing power? What gets crushed? And where opportunities appear when most people freeze? Drop your thoughts in the comments. Do you think we're in stage 2, stage 3? Or is this cycle outdated in a modern world? Thanks for watching.